How to understand complex corporate bond structures. Imagine trying to read a map with many twists and turns. Corporate bonds can be just as complicated, but understanding their structure helps you make smarter investment choices. Let's break down what makes some bonds more complex and how to navigate those details. First, think of corporate bonds as loans companies take from investors. They usually last from 1 to 30 years. When you buy one, you are lending money to the company in exchange for regular interest payments called coupons. At the end of the term, you get back your original investment, called the principal. And like stocks, bonds do not give ownership rights, but they are higher in priority if the company goes bankrupt. Now, the first thing to look at is credit quality. Bonds are rated by agencies based on how likely the company is to pay back. Investment-grade bonds come from financially strong companies and are safer. High-yield bonds, often called junk bonds, come from companies with weaker finances and higher risk, but they pay higher interest. These ratings can change over time, so it's good to keep an eye on them. Next, understand the types of coupons. Most bonds pay fixed interest twice a year, giving you a steady income. Some bonds are zero coupons, sold at a discount and paying no interest until maturity. These are less common for corporate bonds but can be useful for certain passive income strategies. Knowing the coupon type helps you plan your cash flow. Bonds can also have special features called embedded options. For example, callable bonds let the issuer repay the bond early if interest rates fall, which can limit your upside. Putable bonds give you the right to sell the bond back early if needed, offering some protection. Convertible bonds can be turned into company stock, giving you a chance to benefit from stock price increases, but they add extra complexity. Another key aspect is seniority and security. Senior secured bonds are backed by collateral, like property or assets, and get paid first if the company faces trouble. Senior unsecured bonds are not backed by collateral but still have a high priority. Subordinated bonds are lower in the repayment order and carry more risk, often with higher yields. Knowing where a bond sits in this hierarchy helps you understand the risk and potential recovery if things go wrong. Different industries and sectors also have unique risks. Bonds from utilities or finance companies may behave differently during economic changes. Sector knowledge helps you assess how economic shifts could impact your passive income. Lastly, look at the bond's legal protections called covenants. These are rules the company must follow, like maintaining certain financial ratios. Bonds with detailed covenants tend to be safer, but they can also be more complex to analyze. Trustees oversee these rules and protect your rights as an investor. To get a clear picture, review the bond's prospectus carefully. Check the credit rating, understand the embedded options, and consider how seniority and sector factors influence risk. Diversifying your bond investments across different types and sectors can help you earn steady passive income while managing risk. Understanding complex corporate bonds takes some effort, but knowing these key features helps you choose bonds that fit your income goals and risk comfort. It's all about reading the details and making informed decisions to build a reliable passive income stream.